Welcome to Introduction to Business. We're going to be looking at Chapter 14, Accounting and Financial Statements. Our learning objectives include describe the different uses of accounting information, demonstrate the accounting process, explain the various components of income statement to evaluate a firm's bottom line, interpret a company's balance sheet to determine its current financial position, analyze financial statements using ratio analysis to evaluate the company's performance. Accounting is the recording, measurement, and interpretation of financial information. Large numbers of people both within and outside businesses use accounting tools to evaluate organizational operations. The Financial Accounting Standards Board have been establishing standards of financial accounting and reporting in the private sector since 1973. Scandals happened when the accounting firms failed to follow general accepted accounting principles. Today, the Public Company Accounting Oversight Board establishes rules, requirements, and policies for accounting firms and businesses. Accountants are people who prepare accounting information. Certified public accountants, also known as CPAs, are individuals who have been certified by the state in which they practice to provide accounting services ranging from preparation of financial records and the filing of tax returns to complex audits of corporate financial records. Certification gives a public accountant the right to express officially and unbiased opinion regarding the accuracy of clients' financial statements. Most are either self-employed or members of large public accounting firms, although some work for smaller second-tier firms. Ethical accountants are more important than ever after a series of financial scandals in the early 21st century. Sarbanes-Oxley made an accounting firm separate their consulting and auditing businesses, and punish corporate executives with potential jail sentences for inaccurate, misleading, or illegal accounting statements. However, only 5 years later, the financial crisis occurred, partially due to questionable lending practices and investments based on risky financial instruments. The Dodd-Frank Act was passed to strengthen the oversight of financial institutions, limiting the types of assets commercial banks can buy, the amount of capital they must maintain, and the use of derivative instruments such as options, futures, and structured investment products. A growing area for public accountants is forensic accounting, which involves analyzing financial documents in search of fraudulent entries or financial misconduct. These individuals are sometimes called fraud examiners. Forensic accountants have been used since the 1930s, but are now more rapidly being added by many auditing firms. The Association of Certified Fraud Examiners, which certifies certified fraud examiners, has grown more than 75,000 members. Private accountants are employed by corporations, government agencies, and other organizations to prepare their financial statements. Private accountants may become certified management accountants by passing a rigorous exam. They have some degree of managerial responsibility. Although the term accounting and bookkeeping are often used interchangeably, they should not be confused. Bookkeeping is narrower, and more mechanical than accounting, and is typically limited to the routine day-to-day recording of business transactions. Bookkeepers require less training than accountants. Accountants, on the other hand, usually complete coursework beyond their 4 to 5 year accounting degrees, so they can not only record financial information but understand, interpret, and develop sophisticated accounting systems necessary to classify and analyze complex financial information. Many business failures can be linked to ignorance of information contained in the financial statements. Likewise, most business successes can be traced to informed managers who understand the consequences of their decisions. Managers and owners use financial statements for internal and external purposes. Some internal uses include managerial accounting, cash flow, and a budget. Managerial accounting refers to the internal use of accounting statements by managers in planning and directing the course of the organization. Cash flow is the movement of money through the business on a daily, weekly, monthly, or yearly basis. It's not uncommon it's not uncommon for even successful companies to struggle making payments because of inadequate cash flow. One common reason for cash crush is poor managerial planning. A budget is an internal financial plan that forecasts expenditures and revenues over a set period of time. While most companies prepare master budgets for the entire firm, many also prepare budgets for smaller divisions, departments, product lines, or even projects. Top-down master budgets begin at upper management and filter down, while bottom-up budgets start at the department or project levels and are combined at the CEO office. The major value of budget lies in its breakdown for cash inflows and outflows. Managers also use accounting statements to report the financial performance of a business to outside organizations. Such statements are used for filing income taxes, obtaining credit from lenders, and reporting results to a firm's stockholders. These financial statements become the basis for information provided in a corporation's official annual report, a summary of the firm's financial information, products, and growth for stockholders and potential investors. The single most important component of an annual report is a signature of certified public accounting attesting that the required financial statements are accurate reflection of the underlying financial conditions of the firm. Those that meet these conditions are called auditors. The primary use of audited financial information are government agencies, stockholders, and potential investors and lenders, suppliers, and employees. Countries such as Greece and even states such as California and Illinois are experiencing debt overload, which come from the forefront during the financial crisis. A corporation's stockholders use financial statements to evaluate the return on the investment and overall quality of the firm's management team. A poor performance often results in change in top management. Banks and other lenders look at financial statements to determine a company's ability to meet current and future debt obligations if a loan or credit is granted. The accounting equation is assets equals liabilities plus owner's equity. Assets are the firm's economic resource or items of value that it owns. Liabilities are debts the firm owes to others. And owner equity is assets minus liabilities and includes all the funds that have been contributed to the company that has never been paid back. Double entry bookkeeping is a system of recording and classifying business transactions in accounts that maintain the balance of the accounting equation. To keep the accounting equation in balance, each business transaction must be recorded in two separate accounts. Most organizations not only classify transactions as assets, liabilities, or owner equity, but further break them down to provide more specific information. The accounting cycle is a process of collecting, recording, and analyzing raw data. It occurs consistently through the business's life. Step 1 is to examine the source documents. This includes all source documents such as checks, receipts that provide evidence of transaction. Step 2, record the transactions. Transactions are recorded in a journal, a time-ordered list of transactions in which transactions is assigned to a particular account. Step 3 is to post these transactions. Transactions are then posted to a general ledger, a book, or a computer program with separate files for each assets, liabilities, or owner's equity account. At the end of the accounting period, a summary of these balances of all the accounts in the general ledger is called a trial balance must be prepared. Step 4 is prepared financial statements. The information from the trial balance is used to prepare financial statements such as the balance sheet, income statement, and other documents. In the case of public corporations, a certain other organization, a CPA must attest or certify that the organizations follow generally accepted accounting principles in preparing their financial statements. When the statements are complete, the books are closed, and the accounting cycle begins anew for a next accounting period. The physical results of accounting process are the financial statements, the income statement, the balance sheet, and the statement of cash flow. Manufacturing firms, service providers, and nonprofit organizations each use a different set of accounting principles or rules upon which accounting professionals has agreed. These are sometimes referred to as generally accepted accounting principles. Many accounting concepts go by more than one name. Each country has a different set of rules the businesses within the country must follow. Most use international financial reporting standards. Moreover, certain concepts have more than one name. For example, sales and revenues are used interchangeably as profits, incomes, and earnings. Not all financial statements follow precisely the same format. One does not fit all. The income statement is a financial statement showing the profitability of a firm over a period of time. Other names for the income statement include profit and loss statement or operating statement. The income statement indicates the firm's profitability or income, which is derived by subtracting the firm's expenses from its revenue. Revenue is the total amount of money received from the sale of goods or services, as well as the business activities such as rental or property investments. Non-business entities typically obtain revenues through donations or grants. Cost of goods sold is the amount of money a firm spends to buy or produce the products it sold during a period to which the income statement applies. Expenses are the costs incurred in the daily operations of the business. There are three common expense accounts shown on the income statement. Selling, general, and administration expenses include advertising, sales, salaries of executives and staffs, and the costs of owning and maintaining general office. Second is research, development, engineering expenses include scientific engineering and marketing personnel, and the equipment information used to design and build prototypes and samples. And third, interest expenses include the direct costs of borrowing money. Depreciation is included in the selling and general and administrative expenses. It is the process of spreading the cost of long-lived assets over a total number of accounting periods in which they're expected to be used. Net income is the profit or loss after all expenses, including taxes, have been deducted from revenue. Most companies present the current year's results along with previous 2 years' income statement to permit comparison of performance from one period to another. Temporary nature of income statements, companies record amounts of the revenue and expense accounts during an accounting period. Gross profits, earnings before interest and taxes, and net income result from information from revenue and expense accounts. At the end of each accounting period, the dollar amounts in the revenue and expense accounts are moved into retained earnings account, one of the owner's equity accounts. This shifting of dollar value from revenue and expense accounts allows the firm to begin next accounting period with zero balances in those accounts. When a corporation elects to pay dividends, it decreases the cash account as well as the capital account. The balance sheet presents a snapshot of the company's financial position at a given moment. The balance sheet takes its name from its reliance on the accounting equation. Its assets must equal liabilities plus owner's equity. The balance sheet presents an accumulation of all the company's transactions since it began. Assets accounts are listed in descending order of liquidity, how each of them can be converted into cash. Current assets, also called short-term assets, are those that are used or converted into cash within a year. They include cash, temporary investments, accounts receivable, which is money owed to the company by its customers who have promised to pay at a later date, and inventory. Accounts receivable usually includes an allowance for bad debts, and management does not expect to collect. Long-term fixed assets represent a commitment of organizational funds for at least 1 year and include long-term investments, plants and equipment, and intangible assets such as goodwill. Following long-term established traditions, items on the balance sheet are listed on the basis of the original cost less accumulated depreciation, rather than their present value. Current liabilities, also known as short-term liabilities, include a firm's financial obligations to short-term creditors, which must be repaid within a year. Long-term liabilities have longer repayment terms. Accounts payable are amounts owed to a company supplier for goods and services purchased with credit. Other liabilities include wages earned by employees but not yet paid, and taxes owed to the government. These accounts may be consolidated into an accrued expense account representing all unpaid financial obligations incurred by the firm. Owner's equity represents the owner's contribution to their business along with income retained to finance continued growth and product development. Owner's equity accounts vary according to type and class of stock issued. Each type of stock is represented by a separate owner's equity account and called contributed capital. The statement of cash flow explains how the company's cash changed from the beginning of the accounting period to the end. Many investors and other users of financial statements want more information about the firm's cash flow to better understand its financial. The change in cash is explained through details in three categories. Cash from operating activities, which is calculated by combining changes in revenue, expense, current assets, and current liability accounts. Cash from investing activities, calculated from changes in long-term or fixed assets. And cash from financing activities, which is calculated from changes in long-term liability accounts and contributed capital accounts in owner's equity. The ratio analysis refers to calculations that measure an organization's financial health, bringing the information from the balance sheet and income statement into sharper focus. A ratio is one number divided by another, with the results showing the relationship between the two numbers. Financial ratios are used to weigh and evaluate a firm's operating performance. The results of the ratio should be compared to the companies in the same industries and to the company's own past records. It answers two questions. How much does the firm gain or lose? And how much is the firm currently worth on a historical value found on the balance sheet? The profitability ratio measures how much operating income or net income a firm is able to generate relative to its assets, owner's equity, and sales. Profit margin equals net income divided by sales. It shows the overall percentage profit earned by the company. The higher the profit margin, the better the cost control within the company and the higher the return on every dollar of revenue. Return on assets equals net income divided by total assets. It shows how much income the firm produces for every dollar invested in assets. Return on equity equals the net income divided by the owner's equity. It shows how much income is generated by each $1 the owners have invested in the firm. Stockholders are always concerned with how much money they will make on their investment, and they frequently use the return on equity ratio as their one key performance yardstick. Assets utilization ratio measures how efficiently a firm uses its assets to generate $1 in sales. Managers can use assets utilization ratios to pinpoint areas of insufficiency in their operations. Receivables turnover equals sales divided by accounts receivable. It indicates how many times a firm collects its accounts receivable in 1 year. It also demonstrates how quickly a firm is able to collect payments on its credit sales, and no payments means no profit. Inventory turnover is sales divided by total inventory. It indicates how many times a firm sells and replaces its inventory over the course of a year. A high inventory turnover ratio may indicate a great efficiency, but also suggests a possibility of lost sales due to insufficient stock levels. Total asset turnover is sales divided by total assets. It measures how well an organization uses all its assets in creating sales. It indicates whether a company is using its assets productively. Liquidity ratio measures the speed with which a company can turn its assets into cash to pay off short-term debt. High liquidity ratio may satisfy a creditor's need for safety, but ratios that are too high may indicate that the organization is not using its current assets efficiently. Current ratio is the current assets divided by the current liabilities. The quick ratio, also known as the asset test, is the current assets minus inventory divided by current liabilities. By eliminating inventory, the least liquid current assets, the quick ratio test measures how well an organization can meet its current obligations without resorting to the sales of its inventory. The debt utilization ratio indicates how much debt the company is using relative to other sources of capital. Debt financing is riskier than equity as it demands a monthly payment regardless of profitability. In addition, recession effects heavily indebted firms are far more than those financed through equity. Debt to total asset ratio equals total debt divided by total assets. It indicates how much of the firm is financed by debt and how much is by owner equity. Time interest earned ratio equals the operating income divided by the interest expense. It is a measure of the safety margin of a company has with respect to the interest payments it makes to its creditors. A low time interest earned ratio indicates that even a small decrease in earnings may lead the company into financial strain. Per share data is used by investors to compare the performance of one company with another on an equal basis. Earnings per share equals the net income divided by the number of shares outstanding. Diluted earnings per share equals net income divided by the number of shares outstanding, but diluted. Diluted shares include potential shares that could be issued due to the exercise of stock options or the conversion of certain types of debt into common stock. Dividends per share equals dividends paid divided by the number of shares outstanding. Dividends result in double taxation. Banks and financial institutions manipulate their accounts. Repurchasing agreements were common way of removing liabilities from books. Assets and liabilities are transferred to another entry with promise of buying them back later. On the other hand, strong compliance to accounting principles creates a trust among stakeholders. It's most important to remember that integrity in accounting process requires ethical principles and compliance with both spirit of the law and professional standards in the accounting profession. Once again, thank you so much for listening to this lecture. If you have any questions, please reach out to me.